Thanks for joining us for the Executive Series. Today I'm talking to Andrew Lockhart, who is a member of Metrics Credit Partners Investment Committee. Andrew, it's great to talk to you. Now let's talk about the organisation, because you're very much a fixed income focused group. Tell us how you do that.
So Metrics Credit Partners started in June of 2013 with the launch of our first fund. The company started in 2011. So we are direct corporate lenders. We lend to Australian publicly listed companies. We lend to project and infrastructure companies. We're an active lender in the Australian market, and our team has completed in excess of $3 billion of transactions and 80 individual deals that have been completed since June of 13.
Okay, and that's obviously led to the creation of the Diversified Australian Senior Loan Fund. Give us a sense of what your investment philosophy is when this vehicle is concerned.
So our view is that we don't try and favour any individual sector. We're trying to give our investors a broad cross-section of exposure to Australian direct corporate lending. So we lend from high investment grade borrowers through to sub-investment grade borrowers. But it's all Australian and all Australian corporates, and we lend alongside the banks and directly provide that funding to Australian corporates.
Okay, so obviously there's a pretty broad spectrum of credit risk, if you like, within that group that you lend to. So give us a sense of where the risks are along that spectrum.
Yeah. Look, the main risk any investor has in investing in our funds is the risk of credit loss. And so that's where a company fails to make an interest or repay their debt. As a lender, our whole role is to really find and mitigate the risks of those transactions, and so we do a lot of research and analysis around the individual company that we lend to, and then we structure loans with appropriate securities and controls so that we've got a means to understand what's going on with the company, and we can take proactive steps to prevent or limit the downside risk for our investors.
And that's a good point that you make. So limiting that downside risk is obviously a product of how you balance up your portfolio, and that's a reflection of the economic cycle and the interest rate cycle. So how do you structure that given where we are now?
So loans are all floating rate instruments. So when we lend to a company, if interest rates rise, the returns to our investors obviously increase. But what we're interested in is diversifying our exposure, reducing any individual single risk that we take to any company, and we look to diversify it across industries, across sectors, and across borrowers. But we're an active lender. We participate in a market that's a large market in Australia. It's really the most dominant form of fixed income investment opportunity in Australia, but it's a bank-dominated market. Most investors don't have access to that market. It is a bank market.
So, Andrew, the important thing to note here is that you're operating in a space that is traditionally dominated by lending on the part of banks. So you're really opening up this area to mum and dad investors, if you like.
That's right, Tom. Most Australians have very limited opportunities to invest in fixed income and corporate fixed income. The Australian bond market is not a large, deep, diversified market. Most Australian corporates raise funding through banks, and so to be able to bring access to that market is what we're delivering for our investors, is direct access to a diversified pool of Australian corporate loans that otherwise sit on bank balance sheets.
Andrew, great to talk to you.
Thank you.
Thanks for your time.
Thanks, Tom.
Thanks for joining us for the Executive Series.